Hello, my name is Kelly Troy. I'm the president of Insurance for Investors. I myself am an investor, and I've had years and years of experience owning rental properties, apartments, commercial portfolios, and unfortunately I understand some of the things that can happen when you own investment property. This video is to specifically address the issue of seller financing and how to properly insure seller finance property. This is something that is commonly overlooked in the insurance world. Very few agents know how to properly insure this property, and absolutely nobody in the transaction is normally going to understand the insurance aspect of it. Everybody is concerned with the mortgage itself, the underlying mortgagee, and the due on sale clause, and the insurance is often considered an afterthought. However, there are some very serious legal ramifications that can come into play if not addressed properly. To begin with, seller financing was a very popular tool for investors back in the late 80s and early 90s. Loans at that time were assumable, meaning that as long as the underlying mortgagee approved the new buyer, the loan could just be transferred with all escrow monies and payments previously made, and the new investor or buyer now owned the property. Now, after the savings and loan debacle happened, all those rules changed. Most mortgages written today, if not all, include a due on sale clause, which previously did not exist. This clause indicates that any time the title of that property changes hands, the lender has the ability and the legal right to call that loan due within 30 days so that the seller has to pay it in full. If this isn't done, then they foreclose on the property. This obviously causes problems for everybody, and the goal in seller financing is to not only transfer title of the property, but to not necessarily alert the underlying lender that this transfer has taken place. It's not illegal, it just violates the due on sale clause in the loan documents. Now, in a seller finance transaction, you have a few different parties. You obviously have the bank or the underlying mortgagee or lender. You have the seller of the home, the owner-occupants who are needing to sell because they are facing a foreclosure, change in life, whatever the situation may be. And then, of course, you have the end buyer who is purchasing the property vis-a-vis seller financing. The other parties normally involved, you can often have one or two realtors or agents representing both the buyer as well as the seller, and you may have a transaction coordinator, which some of you watching this video may be yourselves. You're facilitating the seller finance transaction. Now, what normally happens is this. John and Mary, who are the sellers of this property, have an underlying loan with the lender, say Wells Fargo. And in this case, let's say that they are paying $1,000 a month for principal, interest, taxes, and insurance, their PITI payment, their full mortgage. Well, that $1,000 comes to the lender, and in most cases, the lender has a separate escrow account set up for this borrower. Now, what happens in an escrow account, and this may be very elementary to some of you who are already aware, but I just want to cover all the bases to be clear. This $1,000 comes to the lender. $700 of it is paid for principal and interest to actually go towards the loan. The other $300 gets siphoned off of that payment each month and put down in here into this escrow account that the lender has set up. So at the end of the year, after 12 payments, there's $3,600 in this account. Now, at the end of each year, when this insurance bill for the homeowners comes due, the insurance company, whoever that may be, is going to send that bill to the lender, and the lender is going to use the money from this account to pay for the insurance. So normally it's a very simple process. ABC Insurance Company sends a bill, say for $800 each year to the lender. The lender turns around, takes $800 out of this account, pays the insurance. And they do the same thing with property taxes and sometimes other expenses as well. Now, the problem comes in during the seller financing transaction itself. The property is in the name of John and Mary, who are on the promissory note and the mortgage with the bank. This escrow account that the bank or the lender has set up is also under the name of John and Mary. So they sell or finance their property to the new buyers, Mike and Susie. So the sale takes place here. Now what has happened is John and Mary have transferred legal title of that property over to the new buyers. However, they are still legally obligated to the promissory note that they signed with the bank. The promissory note is the document that lists you're borrowing $100,000 at 6% interest for a period of 30 years at this interest rate. It lists all the financial terms. The mortgage is a secondary document used during the closing transaction, which gives the lender, i.e. the bank, the legal right to collateralize the loan with this property and to foreclose upon this property in the event that that promissory note itself is defaulted upon. So if they don't make their payments, the mortgage, which is a secondary document, gives the bank the legal right to take the home back. That is an agreement between these people and the bank. These people, the new buyers and the bank, have no agreement at all. The agreement is between the buyers and the sellers of the home. So even though the actual title of the property is transferred, they are still on the hook for the promissory note, the underlying mortgage, and the escrow account is still in their name. Now, many times what will happen, the sellers of the property, during the closing process with the new buyers, will transfer their legal right to any and all monies in this escrow account to the new buyer. And everybody thinks it's fine, that's great, everything's the way it should be. But it's not. The sellers agreed to transfer those escrow money funds to the buyer. The bank didn't agree to anything. And the bank is the one with the account, and the account is in the name of these people, not these people. So what happens during this transaction, the insurance agent, me, gets a phone call and says, we need new insurance for the house. Mike and Susie are buying it from John and Mary by seller financing, and they're going to escrow the insurance. The problem is that the people involved in the transaction tend to look at it the same way as if we were insuring the house at the first stage, but that's not the case. I can't, as an insurance agent or brokerage, escrow this money, because when the bill for their insurance gets sent to the underlying mortgagee, two things probably are going to occur. One, they're going to realize that the name on the insurance is not the same name that they have for the sellers. That's going to potentially cause a red flag to be raised. And number two, they are not going to release funds to pay for that insurance for the exact same reason. The escrow account is in the name of John and Mary. The insurance is in the name of Mike and Susie. They're not going to release funds from John and Mary's bank account to pay for Mike and Susie's insurance, regardless of any backdoor agreement between these two parties. It's not going to make any difference. So that is the first disconnect. What normally has to happen in a situation such as this, Mike and Susie have to set up billing options for their insurance outside of escrow. That means they have to either pay themselves every year by writing a check, or they have to set up for billing options, monthly, quarterly, whatever options are available that they choose. But they cannot pay in escrow because of the reasons we just discussed. Now, there are some agents that deal with investors improperly, that are giving bad advice, sometimes illegal, and which can often be construed as insurance fraud. Now, whether this is intentional or just because of a lack of knowledge, I'm not sure, and I'm not making accusations. I just know what I see on my end. And some of the advice being given is this: that the sellers, John and Mary, are being told that they need to maintain their homeowner's insurance on the property so that the underlying lender is none the wiser that a sale has taken place, and it just keeps getting paid from the escrow account as if they're still living in the home. Then the new buyers are being advised they need to purchase a renter's policy in order to cover their personal contents. I don't even know where to begin discussing the problems with this. First of all, let's talk about the insurance fraud aspect of it. A homeowner's policy is designed to insure property that is owner occupied. these people are no longer occupying that residence. So therefore, a homeowner's policy cannot be written on it. If the agent continues to write a homeowner's policy on it, knowing that they're not living in the home, that is intentional fraud. It is a material misrepresentation on an insurance contract. If a claim ever occurs or there's an issue, it will come up. Secondly, Mike and Susie have a renter's policy on the property. Their personal belongings are protected, their furniture, clothing, everything inside the four walls, but not the property itself. So in the event of a fire, hailstorm, vandalism, any other type of property damage, they have no coverage for the physical property, i.e. the home itself at all, even though they're now the legal owners and they have a vested financial interest. They're not insured. The only people that could file a claim in that case would be, you got it, John and Mary, the sellers of the home that were advised to maintain a homeowner's policy. They may live 5 states away and it's been 6 months and they're just glad they don't have to deal with that house anymore, but they're the only ones that can file a claim because they have a homeowner's policy. Again, a fraudulent issue comes in. They don't have ownership to the property, therefore they can't file a claim. If they do, they're the only ones that can receive payments. They're the only ones that can sign documents. They are the only ones that can discuss the claim with the adjuster. If they're living in a different state, or they are in a remote location, or they just simply don't care anymore, you can see where the problems begin to come into play. So in short, the best way to handle this situation, and there is no good way, insurance is not designed to work in a seller finance situation where the mirror is getting fogged with regards to who owns the property, not letting the bank know, etc. So the best way to deal with this is as follows. Mike and Susie, the new buyers of the property, must purchase a homeowner's policy, regardless of the company it's from. They need to set up billing outside of escrow, meaning they pay the insurance themselves because the bank isn't going to release funds for policy not in their name. Now that they are insured and they are paying the bill, the bank is still listed as a mortgagee on the policy. That has never changed. However, the sellers need to normally be listed either as an additional interest or an additional insured. There is a difference between those two definitions, and it's going to depend on whether or not they are carrying back any sort of small second mortgage, or if they still have any vested financial interest in the property after the sale, as to which one of those they need to be listed as. What will normally happen is the bank will receive the evidence of insurance showing the property address so that they're covered. However, Mike and Susie's name is going to be on the policy, not John and Mary. Most times, and this is where the risk comes in regards to the due on sale clause, most times the bank isn't going to pay attention or, quite frankly, really care if the policy is in a different name, as long as they see John and Mary's names somewhere on the policy with themselves listed as mortgagees and their payments are current. Normally it's not going to be an issue. The case always exists, however, that the underlying lender does have the legal right to call that due on sale clause in the mortgage due. There's nothing that an insurance broker, the insurance company, or anybody else can do about that. That is a risk that is taken through the process of seller financing, and all parties going into seller financing need to be aware that that risk cannot be mitigated. It is what it is. 99.9% of the time, that due on sale clause will never be an issue. There is that potential that it could. And again, there's nothing you can do about that except to go through the transaction and hope that it never does come up. Again, I'm Kelly Troy, Insurance for Investors. If you have questions regarding your seller finance transaction or how to properly insure any other type of investment-related properties, please don't hesitate to give us a call. Our number is 800-299-8994, and you can also email us at info@insuranceforinvestors.com. Thank you.